Hi, I'm Paul D. Garrison with J. Parr Real Estate. Thank you for joining me today. I wanted to take just a moment to touch on a topic that we've been hearing a lot about in the news lately, and that's debt. Whether it's the talk about what's going on with the debt ceiling or the news that consumer debt is at record levels, it's got a lot of my friends and clients asking me whether this is likely to cause another housing crisis. Well, I tell them that that's not very likely, but to help explain why, I've asked a friend of mine, David, to take a few minutes and talk to us about it. With that, I'm going to turn it over to David. David?
Thank you, Paul. The topic of debt is going to come up more and more. The national debt or the deficit is higher than ever before. Consumer debt is higher than ever before. And people sort of look at housing and go, okay, how does that all impact the future of the housing market, and get a little scared, honestly. And so if we focus in on the housing piece of this, we start to talk about, is the market going to crash? I use this slide right here, and it shows consumer debt and how it's at a record level in this country, almost $18 trillion in consumer debt. And that's everything from home equity lines to auto loans to credit cards to student loans. Oh, by the way, mortgages make up the big portion of that, and people start to get concerned, right? If you take that picture right here, mortgage debt is almost $13 trillion in this country and makes up about 75% of consumer debt, and people get worried if you look at that line just right here, 13.1 trillion in mortgage debt. Well, here's what they miss in that sort of thought is that there's 35 trillion in equity in homes across this country. So very, very strong. And I think that strength is going to play out a number of different ways in ownership in the coming years, and already is playing out in a couple of different ways. And we're going to talk about that in just a minute with foreclosures. But no doubt there's a tremendous amount of equity in homes across the country, which is giving strength to the real estate market. ICE Mortgage Monitor report said equity growth has begun to moderate along with broader home prices in recent months. But that's still the largest volume of equity we've seen on record adjusted for seasonality. The average homeowner has $319,000 of equity in their home, of which $207,000 could be borrowed against while still maintaining a 20% equity position. So the strength of the homeowner relative to equity is tremendous. Rick Sharga said this for a homeowner in the early stages of foreclosure, that equity is going to help them avoid foreclosure either by leveraging the equity to pay down past due mortgage bills or by selling their property in order to protect the equity they otherwise lose at the auction. So I mentioned we're going to dip our toe into what's going on with delinquencies and ultimately with foreclosures. The reason for that is we see this tremendous amount of equity, and it's playing out inside of delinquency and foreclosure rates. If you take a look at this right here from the New York Fed, this is the percent of mortgages that are 90 plus days delinquent through the third quarter of this year. And you see right here below 1%, the tremendous rise up right here in the housing crisis. And we've steadily come down and stayed down over the last several years. Now, it was interesting talking with a large servicer of mortgages in this country, and they generally are good in their portfolios. When the default rate stays below 1%, they would say that's completely acceptable. That's healthy. You see, going back here in the early 2000s, bouncing around 1% and not only being past due, but maybe could lead to a default, or it could lead to something like that. But the good news is, with a tremendous amount of equity, if someone were to go into foreclosure, they have the ability to put their home on the market to pay a commission and probably put a little bit of money in their pocket to get to the other side of the financial crisis they and their family are facing. Adam Data said this. In October of 24, the U.S. housing market experienced a slight uptick in foreclosure activity with 30,784 properties filing for foreclosure, marking a 4% increase from the previous month, but an 11% decrease year over year. This nuanced trend shows foreclosures remain relatively low despite monthly rises. Let's go back to this slide. This is delinquencies right here. They're talking about foreclosure activity. This is the look at activity right here through the third quarter, and we can see activity on foreclosures remains very, very low. Again, I'm going to say due to the strength of the homeowner, due to the strength of a well-qualified borrower coming out of the financial crisis, which is the one thing that was given to us as a gift. It maybe didn't feel like a gift along the way, but it became harder to qualify for a home loan. And these well-qualified borrowers intent on not misusing their equity have produced a very strong homeowner in the sense of a sort of balance sheet, if you will, of a homeowner. So while foreclosures spiked up in the housing crisis, they've come down and stayed down post-crisis. A lot of people worried that during COVID right here, there was obviously forbearance and moratorium on foreclosures, that once we came out of that, we'd be in a serious problem, but certainly hasn't proven to be true because of all the things that we just talked about. So we'll continue to watch that. But as we wrap up the year, I think you can be strong in your position that foreclosures, we're not going to see a wave of those and a flood of those coming back into the market.
Thanks, David. That was very helpful. I hope you found that helpful as well. If you still have questions about this or anything else real estate related, feel free to reach out to me. I'd love to hear from you, and if I can't help you, chances are I know someone who can. Till next time, this is Paul D. Garrison with JPAR Real Estate, wishing you the very best and hoping to hear from you soon.